Welcome to the KMG Fiduciary Partners Podcast. Here, we'll cover important topics on financial planning and asset management to help keep you informed and inspired for long-term success on your financial journey. Let's join the KMG team now for today's topic. Welcome to the 10-Minute Advisor, brought to you by KMG Fiduciary Partners. My name is Cameron Kaiser. I am a CFP professional and a wealth advisor here with KMG. I'm here with Rob Thompson, who is a CPA and also a wealth advisor with KMG. Rob, you mind going ahead and explain the format of this video to everyone?
Sure. So today we're going to try and cram as much information about the history, functions, and limits of Roth IRAs that we possibly can within 10 minutes.
Okay, and we have our producer here, Mark. He has a stopwatch, so we can stay true to that objective of 10 minutes or less. So, Mark, can you go ahead and hit the start button on that thing? All right, awesome. So, Rob, where do you want to start this off at?
All right, well, I think it probably makes the most sense to just start off with a little bit of background on the history of Roth IRAs and kind of how they came to be what they are today. So you want to take a crack at that?
Yeah, sure. So in past podcasts, we've talked about the rise and decline of pension plans in America and how back in the day they used to be the norm for most American workers. But even before the decline that we started to see in the 1980s, Congress realized that not every single American was entitled to a pension plan. And because of that, they needed some way to incentivize Americans to save for retirement. So along came 1974, Congress passed the Employee Retirement Income Securities Act. Now, most people know it by its acronym ERISA, but within it had many provisions, one of which was the individual retirement account, or what most people know it today as the traditional IRA. Now, the way this worked back then and still does is that you'd be able to put a portion of your money in tax deducted, the earnings would grow tax deferred, and then during retirement, it would be taxed at ordinary income or your marginal tax rate. Now again, initially this is pretty small. It was the lesser of 15% of your income or $1,500, but it was a step in the right direction. Again, so kind of laid the groundwork for different retirement accounts, and as time went on, different provisions were made. And then in the 1990s, the Taxpayer Relief Act of 1997 was passed. In it, it introduced the Roth IRA. Again, some background about the Roth IRA. It was named after William Roth, a senator of Delaware, who at the time saw that even though we had all these retirement plans in place, and even though we had all these provisions, Americans still weren't saving nearly enough to, help them out in retirement. So what happened was he said, okay, let's take some of the principles of the traditional IRA, but let's switch it a little bit. Instead of getting that tax deduction, let's let the earnings grow tax-free. Let's also make it a little more flexible so you can access that principal anytime you want, and let's get rid of RMDs, required minimum distributions. For those of you that aren't familiar with RMDs, they are applicable to most tax-deferred accounts. So when you turn 72, you're forced to take a portion of money out of that account and pay taxes on it. So I think that's Roth IRAs in a nutshell. Do you want to go a little deeper, maybe talk about who can and can't contribute to Roth IRAs?
Sure. So I think first and foremost, it's important to understand that Roth IRAs are a unique vehicle, and it's this type of thing where you basically have to have earned income, right? So you have to make some money somehow, but you can't have too much earned income. If you have too much, then you're kind of out of luck and you have to utilize one of the alternative options to getting your money into the Roth bucket. So the income limit thresholds, at least for 2022, and this is referring to modified adjusted gross income, for single filing taxpayers in 2022, that income limit threshold is $129,000. So basically what that means is unless your income is less than $129,000 and you're a single taxpayer, you're likely out of luck in terms of making a direct contribution to Roth. Now, there are some workarounds, but we'll cover that later. That same number, though, in order for a married couple to make contributions to their Roth IRAs is $204,000 for 2022. And again, that's stated in modified adjusted gross income terms. The maximum contribution in 2022 is $6,000 for people under age 50. And if you're age 50 or older and you do have earned income, again, that's something that stays true no matter how old you are, you can make an additional $1,000 contribution, bumping you up to $7,000 per person. So, and I kind of hinted at age limitations, which when we're talking about the Roth, there are none. Some other things, and this is a big thing. You kind of touched on it when you were just going over the history, but when we're talking about making contributions to Roth, that money is going in after tax, right? So we've already paid the income taxes on that money with basically knowing that we're never going to have to pay income taxes on it again. So it's a great opportunity to kind of take control of the tax bucket and say, okay, I know I've already got maybe a little bit of pre-tax money over here, a little bit of after-tax money over here. It's a nice blend, right? But the contributions on the Roth bucket are always something that you can actually take out, and there's no penalties or interest or income taxes on it, right? So that is different than, let's say, the traditional IRA, where whether you take out the contributions or even the earnings, you're kind of stuck paying the income taxes along with the 10% penalty if it's an early withdrawal. So one thing to note here, though, basically there's a 5-year clock, right? So what that means is 5 years after your initial contribution, assuming that you meet the age requirement, which is 59 and a half, you can begin actually withdrawing not just the principal, but any earnings on those contributions tax-free.
Yeah, and I think that 5-year number is important too, because the 5-year number also applies to if you make a Roth conversion instead of a direct contribution. Again, usually if you assuming you don't have the phase-out limits, you're going to make a direct contribution. But if for some reason you're past the phase-out limit and you want to convert something, or let's say it was in a tax-deferred account previously and you want to convert it to Roth, a 5-year number is right there. So basically the second you convert it, you have to wait 5 years until you can actually touch that principal. Again, it's not something we see too often, because the idea is if it's in a vehicle like a Roth that's growing tax-free, you want to keep money there as long as possible because you want to utilize that tax-free growth. But I think it's important to be aware of.
Yeah, and really what we do, we're always kind of looking at the long term, and these things that we do today make a big difference tomorrow. With that being said, typically we're not going to recommend somebody to take out the contributions of the Roth IRA if they put them in 2 years ago.
Sure.
But there's unique circumstances for everything. But I feel like we're probably coming up on, how are we doing, Mark?
We've got 3 minutes, 19 seconds left.
Okay.
All right. Is there anything else you want to add within those 3 minutes?
I think anything else, we're probably going to go into a little bit more depth, so we're going to need a little bit more time. So I think for today, we're probably good to stop this here and stay true to the whole keeping it under 10 minutes.
Perfect. That was quick.
Awesome. Well, hey, thanks for tuning in. Be sure to check out any other videos that we put out there. We're going to be discussing Roth in future episodes and get a little bit more advanced there. But in the meantime, please contact us if you have any questions or would just like to set up a time to meet with us at kmgfp.com.
Thanks for joining us for this edition of the KMG Fiduciary Partners podcast. We invite you to catch the next episode in our series for real-world advice from the KMG team. Follow us on LinkedIn at KMG Fiduciary Partners, where we'll keep the conversation going.